Hello, everybody. My name is Bob Klutsis. I am president of All-Star Financial, and we are here with you on the All-Star Financial Quarterly Review webinar, third quarter 2012, entitled this quarter, As the Global Economy Slows, Liquidity is Unleashed, and Will It Be Enough to Ignite Our Economic Growth? When we look at kind of Bob's Corner, and I know kind of by standard I like to talk a little bit about what's going on before we get started, but the election year has brought a lot of uncertainty in addition to the political things that are happening there, but that volatility has been really, really evident. You know, we were up almost, let's say, on average 10% the first quarter, down 5 the second, up 5 the third. And again, that volatility has been created by the uncertainty of what's going on out there. And whether it be political or any other situation, we really need to get a handle on our debt and jobs. So I'm with everybody else out there that it's been hard to really manage money the last 24 months because we haven't had people making decisions. I would please get out and vote, whether you're Republican or Democrat, and make your voice be known and then make them accountable in the long run. Getting to the market overview. The market overview, you can see the slower economy across the globe. Europe's debt still continues to really trouble most of the world, along with the twin engines of the U.S. and China being affected by their debt and our own debt. And in reaction to that, really, the European Central Bank and the U.S. Fed forced to really buy the bonds. They threw a lot of money and a lot of liquidity out there to try to get the economy going. Even with that, there's still uncertainty that abounds. Again, those elections, the fiscal cliff, I think, is a big, big deal. And then the global deleveraging, obviously, a big part of it. But why did the market rally in amongst all of these concerns? Well, we look at a slowing growth in the economy, slowing even more than it was year over year. GDP was 1.3% in Q2. Estimate for Q3 isn't out yet, but they project it to be even lower. Consumer spending's down year over year, as you see, from 3.6 right now, from 5.1. And the jobs, we just aren't creating enough jobs. We're creating jobs, and there's a little bit of an inch up of how many jobs we're creating per month, but nowhere near the 300,000 that we need. But the big question is, savings rates are still good at 4%. CPI is still low. Housing values have risen the last 6 months. Foreclosures have gone down. So even in amongst all of this negative economic news, there are some positives. And obviously the spin that they take with the political atmosphere that we have on that. Looking forward from the economy, the aggressive monetary policy really will be the norm for now. That what we define as QE infinity, that $40 billion a month in bond purchases, is going to be really, hopefully, that impetus to get us to self-sustaining growth. Right now, with QE1 and QE2 behind us, what we saw with those is really just a blip in the GDP, but it wasn't enough to gain confidence enough for the consumers and the businesses to spend to really carry the torch. So as we look at this $40 billion, and I look at it kind of as a Ponzi scheme, because we're basically robbing Peter to pay Paul. We're just bringing liquidity to the table through the government form. But again, we need that consumer and that business to start doing it. So as we approach the fiscal cliff, there's really a short-term fix or a long-term fix. Short-term is really to extend the tax credits. Long-term would be to raise taxes, in my mind, and decrease spending. I think it's pretty simple, but let's see what our politicians do here in the next 2 months. Market on the bond side of the world, again, the Fed has a very, very aggressive mode of operation based on the liquidity and trying to get the economy going. And basically that helped the high yields. The corporate and the global bonds benefited from all of those. It really hurt the Treasury bonds. Treasury bonds are only up about 0.6 for the third quarter. high yields were up 4.3 and globals were up 4.0. So again, that aggressive nature created a lot of volatility in the bond market, but kind of stayed right around the same yield at the beginning of the quarter to the end of the quarter. Didn't help Treasury bonds. It hurt it, actually. Bond market going forward, I think we can count on low rates really to stay until 2015. I think that's probably imperative. And in this atmosphere, the high yields will probably moderate a little bit more as the federal government buys the mortgage-backed securities and creating that demand side of the equation, which will help them the most. I also think that the emerging markets are still a good buy. So looking forward, we'll probably still maintain the emerging exposure in your bond portfolio as well as the short-term government and corporate bonds, a little bit of high yield also. Domestic stock market, when you look at kind of the definition of climbing the walls of worry, we had a lot of worry this quarter, but it climbed it. We made some really good money. And even though corporate earnings are down, the growth is slowing, uncertainties abound, the markets had really positive outcome. You saw the broad market at 6.2 domestically. Within that, large caps outperformed mid caps and small caps. Value outperformed, excuse me, outperformed growth. And when we saw kind of the tech sectors that did well, energy did the best at 9.5, and with tech close behind at 7. The worst performer that was positive 5.5 last quarter were utilities. So we saw kind of a reversal of fortune there. So when we look at kind of the markets going forward, domestic in particular, the margins aren't quite as good as they were, 12 months ago when really it was 30% cheaper. PE ratios right now are a little bit below long-term averages, but I think it's fairly expensive for our forward-looking earnings. Healthy balance sheets are still there. The big question is, I think, are can corporations still maintain their earnings with the uncertain times? And can the dividend payouts that we're seeing bring action to equities and demand for equities that we haven't seen in the past? And I think that that's going to be a big part of the equation. So when we look at kind of the international side of the world, we saw really that same rally that came from within, not really out of numbers, because the Europe's progress with the European Central Bank supporting Spain, Italy, and Portugal made some inroads to getting it figured out, but it takes so doggone long once they get things figured out to have it actually bring into action. Amongst all of that, European stocks were up about 9%, Asia Pacific stocks 8.2%, emerging market stocks 7.5%. Japanese stocks were essentially flat for the quarter. Looking forward, I would define us kind of in what I believe to be kind of a contained strong opportunity situation where stocks are cheaper than the U.S. right now. Very high dividends, double the U.S. Emerging still very strong, and there's more powder in their gun than any other countries around the world. Demographic trends bode well for the international stocks, particularly emerging markets. But again, the big question is the debt, and we will hopefully see fairly quickly what that says. Really, in summary, it brings us to a fork in the road, and we really need to find a way to sustain that growth without Fed action, that QE infinity that we're seeing right now, or we're going to have a risk of stalling and I think go into a potential another recession. Dividend-paying equities, I think, are going to play out really well. As I said, the total return equation, as interest rates stay low and people kind of figure out that they can get about the same, if not more, dividend payout from a stock and then upside potential, I think that that's going to help the market a little bit. And hopefully we'll create a longer-term atmosphere like we have where there's less volatility and better compounding. We went back on our fourth page of our newsletter, went back and talked about kind of what was going on with the last 13 and a half years. And we look at the last 13 and a half years from 3/31 to 9/30 of 12, the compounding effect of $10,000 with the Russell 3000 was 15,700, a little over 700. All-Star Financial's average of their 4 portfolios was a little bit under 16,700. So about $1,000 difference over a 13.5-year time period. That means for every 10,000, there's $1,000 better performance, more money in your bucket than it was the broad market index. For every 100,000, it was 10,000. For every million you have with us, it was over $100,000 the last 13.5 years that we were able to bring to the table just by creating less volatility. And basically, in a nutshell, we outperformed per year over the last 13.5 years about 0.34% with 27% less risk. So again, it's kind of nice to be rewarded for our patience and our discipline of reducing volatility. In the long run, compounding effect of our dollar becomes more efficient. So we want to thank everybody for your continued trust in the All-Star team, and remember our referral program. You could throw this out to somebody. We apologize for it being as late as it is. We have a new web host on our website, so that brought a few difficulties here. But we always thank you for that. I want to mention a couple of things too. Andy Peters is a new account executive with us. Welcome, Andy, and looking forward to what he brings to the table to help us serve your needs. Have a great day, everybody, and we'll look forward to talking to you soon.